Olivia's going to record. And we're recording now, so feel free to unmute and ask any questions, as we go along. It's just you two on there. We had a couple more signed up, so we'll see if they jump on. Olivia will grab them and add them in there. If not, we'll go through some different options on buy before you sell and answer any questions you guys have. So that's what we're here for. Buy before you sell. We're going to go over some basically ways to waive your home sale contingency. What is buy before you sell? We'll go over some different options like using a home equity line of credit, a HELOC. And then we've got really three different programs, Home Light, Boost, and Zavi, that will kind of go through the differences of each one to see what would be best potentially for your clients down the road. So do you guys have any questions before we start?
Yes, Arlene has one. Arlene, just unmute yourself.
Hold on. I'm having technical difficulties.
We can hear you now.
Okay. How long has this program been offered? Because I haven't seen it. I haven't seen any offers. Do you write the offer the same exact way, Dave?
Yeah, so it's been around. It's really come about really because of the market that we're in right now. Everyone, has, for the most part, is selling their house. They have really good equity, and then they're purchasing a new property. But the market's so busy right now as far as buying a property that you really have to get in there with the least amount of, contingencies as possible to get in there. So these programs like this, kind of like a 2-1 buy down, things like that, they've really come about the last couple of years because of the market. So that's how long they've been around, really for a couple of years. But as far as using them, it's most of these programs, for the most part, with the way houses are selling right now, you can kind of use these as backups, but hopefully you won't have to use them because your home will sell prior to the purchase of the new home. So in that case, it's kind of best case scenario. So we'll go over the different options and kind of see, and then we'll kind of go over the options where if your home doesn't sell prior to you buying the new property or having to close on it, then what those options are and what these different programs will do for you.
Great, thanks.
Sure. So what's the home sale contingencies? You guys know what it is. All the realtors know what it is. This is a way to kind of avoid that, but that home sale contingency is when your buyer's offer is subject to the sale of their home. And usually it's because it has to be, because they're going to need to use those funds from that sale to put toward their new purchase. And some of the reasons why might be because they don't want to sell until they purchase the new one. It could be buying new construction and they want to stay in their house until they either renovate the new property or it's completed, new construction. So there's some different options on that, but we'll go over how we can avoid that home sale contingency. And these are some of the programs we use: the home equity line of credit or HELOC, Home Light, Boost, and Zavi. So let's just dive right into it. The same options right there. So this is what I tell my realtors prior to doing anything when they're going to list a property. Always have this conversation with the seller about, do you need to sell prior to buying? And if they do, then these are the options for them. And like I said in prior meetings, I'd be more than happy to go to any listing presentations to meet with your buyers as well and kind of be there as the financial person to answer any questions they have. So keep that in mind if you ever need me to go on any listing presentations with you. But the home equity line of credit, some people may already have one on their home, and some may not. If they don't, or even if they do, they may want to either increase that line of credit if they already have one, or take out a new home equity line of credit prior to listing the property. So a bank most likely is not going to give you a line of credit if they know you're selling the property in the future, or the near future, I should say. So I always tell borrowers, hey, go for a line of credit and just tell the bank that and it could be to fix up the property, even if it's prior to selling, or being used for home improvements, or even just a security blanket to have if you ever need it should other costs arise. But generally, that's the best way to go. So you can access that equity in the property and use that home equity line of credit if you need it, if your property doesn't sell, for the down payment for the new property. So we should always be talking about this option with the sellers when you're talking about purchasing the new property, and how that is all going to jive. So generally a home equity line of credit, and again, this is a line of credit, so it's not a home equity loan, which is another second mortgage, which could be used also. But a home equity loan is when you get all that cash out right up front and you start paying a principal and interest payment on that home equity loan. This is a line of credit, and you don't make any payments on it until you actually use the line of credit. So if you end up purchasing the new home with this line of credit, you might access 100,000 of it. You'll pay interest only, generally for a 10-year period. Here, you're just going to be paying it until the property sells, and then it'll get paid off with your first mortgage. But again, if you end up not using it, there's no payments on it. Generally, the closing costs are either no closing costs if it's under 100,000, or the closing costs are really minimal. There might be a prepayment penalty in there, but it might be $300 or $400. But in the whole scheme of things, it's really not that much. And again, it's usually interest only for a certain time period, like 10 years. And again, this is more of a short-term option for you as well. And a lot of times they'll just use an automated appraisal. So there's not even an appraisal on your property. They'll just use an automated value, see what they can come up with, excuse me, for a value, and then run all the numbers from there. So they'll usually take like 90% of the value of your home, and then they'll subtract the balance of your first mortgage, and the rest would be available for your line of credit.
Is there a penalty for paying it off?
Yeah, so there's usually, like for home equity lines of credit, there's usually like a 2 or 3 year prepayment penalty. But those penalties are usually, and this is something you would want to ask up front with your bank. So you can either get these through your bank, or we could actually offer them also. But they're generally like a $350 or a $500 prepayment penalty. And it's more just to cover the cost of them doing having their costs up front for either their own valuation system or their attorney or their branch closing the loan and doing the paperwork and things like that. So it's not a lot, but that's definitely something to ask for up front when you're checking around on home equity loans. Any other questions? So one problem with the home equity line of credit, if we go down to bullet point 3, is you can access those funds, and then you also have your balance on your first mortgage and a payment on your first mortgage. You have your interest only payment on your second mortgage, and then you're buying your new property. So in that scenario, we've got your current mortgage, your home equity line, your new mortgage, and you have to qualify for all that, right? So that's the Fannie Mae, Freddie Mac guidelines. You have to qualify for all of your debt if your home's not sold prior to. So one way to get around that would be to put your property under agreement. Put your property under agreement. So I'm going to slip back to that last line. Put your property under agreement and have it approved with no contingencies. And if we can do that, then we don't need to include the payment on your first mortgage and your second mortgage when we qualify for you for the new property. So does that make sense?
As long as it's under agreement.
Yeah, under agreement and with no contingency. So basically, they want that clear to close letter, that final commitment letter. And then we don't need to include that payment. So if we can't do that, right, or if it's not under agreement prior to the sale of the new home, then we can start talking about these new options. So the Loan Store is one of our good investors and lenders that we have, and they've got their programs called Home Light. And this program, they'll actually give you on the equity on your current home, they'll go up to 75% of the value of your home minus any first mortgages, and they'll just do a line of credit like we were just talking about, with 0% interest for up to 90 days. And they'll go up to 2 million if you need to go up that high. They're usually approved in 24 hours. At that point, you're going to go ahead and purchase the new property with the equity on the home equity line for the down payment. And again, we can use any type of financing for them on the first mortgage, but we'll allow you to provide a non-contingent offer on the property, because what they'll do is they'll actually provide an offer on the property as well as the home equity line to fulfill that financing contingency. So theirs will be non-contingent. It's kind of like a cash offer on the sale of your departing home, so that it fulfills that Fannie and Freddie guideline. And then once you buy the new property, again, we don't have to use the debts on the old property. Once you buy the new property, you list your current property. You have 90 days to sell it. You still have to make your normal mortgage payments on that. But again, the home equity loan on this one, there's no interest on that for 90 days. No interest and no payments on that for 90 days. If the property is not sold, so if the property doesn't get sold, then HomeLight will go in, they'll buy the property for the balance of your mortgage, okay? And then they'll put the property back on the market with you, the realtor, and they'll put it back on for the market value, right? Even though they bought it for the balance of your mortgage. And then when you sell that property for your seller, all the proceeds minus any fees will be given back to the seller. So it's not like they're buying it for a low amount. They're going to keep that property and sell it and make the money on their own. They're not in the business of buying properties and reselling and doing that. They want to, hopefully you'll just have that property sold in 90 days. But if not, this is the option that we have for them. So the cost is 1.2% of the sales price if the departing property is sold. So for them to put up the offer as a backup offer for the sale of their home, the cost is 1.2% of the sales price of the departing home. It's 2.4% of the sales price if they actually need to go through and buy that property if your property doesn't sell in 90 days. So for the extra work, it's another 1.2% of the sales price of the sale of that home. None of that gets paid out until the property is sold down the road. So the departing property, once that gets sold, those fees are taken out at that point. And that would just be part of the closing costs. So questions on HomeLight?
Is there an appraisal done by the lender, by HomeLight?
So they'll do like an automated value just to make sure that it's not upside down. Pretty much nothing's upside down right now. And plus they're only buying it for the balance of your mortgage. So they're not going to get hurt really either way, because generally the balances on mortgages these days are a lot less than what properties are worth. But they said they'll do like a automated value just to make sure it's not close or something like that. If it is really close, they might do an appraisal just to make sure.
Okay. If somebody has 100% equity, a paid off home, is it better to just use the equity line of credit? Is there one advantage over the other of these two, or?
Yeah, because they would use that line of credit. Well, if they can qualify. So that's a good question, because they really don't have any debt on their property other than just their taxes and homeowners insurance, right? So if that's the case, as long as their income's enough to qualify for the new property, the new principal, interest, taxes, and insurance payment, plus just their taxes and insurance, and then plus that home equity loan, if we're going to give them 100,000 or 200,000 or 300,000, then if they qualify for it, then the original home equity loan is the best way to go. If they don't qualify for all those payments, then these are the options that come into play. So whether they have a mortgage or not, they still might not qualify. They could potentially be on a fixed income, have a lot of equity in their house right now, but maybe they're retiring, so they're not working anymore. They have Social Security, maybe a pension, and it's not going to cover all of their payments. So that would be a good scenario where they would do this type of home equity loan, have no payments on the home equity loan until they sell their house, and then that home equity loan would be paid off. Yeah, exactly. Did that answer your question, Paul?
Yes, yeah, perfect. Thank you.
All right, cool. So the next one is through a lender that we use, LendSure, and it's called Boost. And with this program, it's kind of like a bridge loan. So remember the old bridge loans where we'd take the value of both properties and we do 80% of that value and we'd pay off the old mortgage with it. And then when that loan gets paid off, we'd pay the balance down to whatever you want for your regular mortgage.
I was
Well,
going to ask you about bridge loans. I was going to date myself because I work with a lot of older clients than me.
yeah, yeah,
But
that's
I'm 60, so it's like I work with people. But I was going to say they always go, "What? I'm going to probably just get a bridge loan." I'm always like, "Do they even have those anymore?"
Yeah, no, literally there weren't bridge loans for like 10 years. And now the last couple of years, this is just another product that LendSure came up with in lieu of like that, buy before you sell scenario. So what these guys will do is they'll do a cash out refinance on your primary residence. So they'll refinance your first mortgage and give you cash out up to 75% on your primary residence that you're selling, and they don't care that it's selling, and they know it's going to be sold off in hopefully 30 days, 60 days, up to 1.5 million, up to 65%, up to 2 million, loan to value up to 2 million. And they'll also do 60% loan to value for non-owner occupied properties, and second homes. So you can actually use this bridge loan on investment properties and also second homes. Now, just keep in mind, this scenario is you can't be selling your primary home to buy a second home or an investment property. It has to be primary to primary or investment property to investment property or second home to second home. So if we just look at primary residence right now, they'll do up to 75%, up to 1.5 million. That should cover most people. They'll do a cash out. Their cash out refinance will be a 12-month balloon, and there'll be no payments until that 12-month is up. And then you need to refinance that and pay that off. So that basically gives you 12 months to sell that property. So, most people obviously aren't going to need 12 months, but if you're building a house, this would be a great scenario for you. So we've got 2 loans in the pipeline right now where the people are building and the homes aren't going to be finished for at least a year. So this could potentially be a good option for them if for whatever reason they wanted to purchase that home up front or they need that cash up front. So they do a cash out refinance. There's no payments. Because there's no payments, LendSure will actually do the mortgage on the new property as well, and they won't include the payments because there are no payments on the cash out refinance for qualifying. So you can qualify for the new property based on your income and just the new payment. So kind of the difference between this program and the prior home light program is there's no 1.2 or 2.4% cost when you sell your house. You're just going to pay off that mortgage when you sell that house. So the cash out refinance and the new mortgage are done right at the same time. And again, we can do it for non-owner occupying or investment properties and also second homes. So how does that look? Questions on that? Let's jump over to Zavvy. So Zavvy is a company on its own. They don't provide mortgages, but they have a service depending on what you need, whether you're a first-time home buyer or whether you have a home to sell. Their programs are kind of tailored to all the services that they offer. So for a first-time home buyer, this will allow you to put your offer in as a cash offer. Again, you're not selling your home because you're renting. So it'll allow you to put your offer in as a cash offer to purchase the property, and they'll just charge a fee for backing up that cash offer. If you have a home to sell, then they'll allow you to put a cash offer in on the new property, and They'll also assure that your home will be sold as well. So they'll for the fee for that is more because they're providing a higher service for that. So the cost of a new home purchase for new buyers is 1%. It's 1.9% for clients who have to sell their home before they buy. Plus, again, any costs associated with that. So if Zavvi ends up buying your home, let's say worst case scenario, you haven't sold your property and they need to purchase that new property, then you'll be covering the cost of their fees to buy that home. Plus, they're going to sell that. They'll have an agreement with you ahead of time to sell that property back to you for the same cost of what they bought it for. But again, there's closing costs in that scenario too. So you're going to be paying two sets of closing costs plus the fees for that program. But it allows you to walk in and potentially negotiate a better offer as cash because you have that addendum that will buy that property as cash if your financing falls through for whatever reason. Does that make sense? In this scenario, you need the 660 FICO score. You need to be putting at least a minimum of 5% down on the new property. And they only offer it for conventional mortgages. You can't be financing the new property with VA or FHA or USDA or New Hampshire Housing or something like that. They just offer this program for just conventional financing.
Is this available for in both Mass and New Hampshire?
Yes, it is. Yeah, and Maine as well.
Okay.
Yeah, they're nationwide. Yeah. And we've got some good materials from them that we could forward over to you as well. And it kind of explains each program and what their costs are for each program and how it would pertain to like a renter, a purchase, a borrower who has a home to sell, and things like that. So, and again, if your house sells prior to the purchase of the new home, then the fees are basically half of what they are if they actually need to go through and purchase the home and then do all that work to resell it to you after your home is sold. So as a recap, those home sale contingencies, they can be omitted with certain programs, home equity line of credits, the cash out refinances, the cash buy offers. The buyers can access the funds from their current property for the down payment. So those will be the conversations you'd have with them when they're sellers on how to access those funds. Certainly they can just give us a call and we can go over some different options with them. Because they all seem to have that question when we're talking to the sellers, they're buyers for us, but they're all asking, hey, how does that transition from selling to buying? How does that work? So we explain, the different options for them and how to access those funds and how to exclude, departing debt from the old property, from the departing property to the new one. So we have this conversation with just about, every buyer that we have that currently has a home. So, questions from everyone?
All right. So, Dave, I have some people that have been contemplating selling their New Hampshire home that is paid off for and buying new construction. And in the case where there's no mortgage, but they're looking to probably pay more for the new construction than what their home is currently worth in New Hampshire. What is the best scenario for them with all the options that you presented today?
Yeah. So new construction, there's two ways to finance new construction. So there's a construction loan where the builder's not going to finance it, and you would get a construction loan. And if they sell their house and make $500,000 and the cost of building a new house is $1 million, they've got a $500,000 mortgage in there to cover the difference. So they can get a construction loan to cover the difference. In that scenario, we can talk about construction loans, but that's kind of a different webinar, but that's an option that we can offer them. Or the builder will finance it. So a lot of builders right now don't want to deal with a construction loan and they want to use their own line of credit, build the property, and then the buyers will just do that $500,000 loan at the end to purchase the property. That's what's happening with those two construction loans or those two new construction purchases that we have now. They just went under agreement literally 2 weeks ago. They're not going to be completed for a year, one in 2026. And but the builder's financing the whole thing. So we've got them pre-approved, and they both are selling a house too. So we've got them pre-approved. They're going to stay in their home until, the home is complete. And then we're just going to do the end loan, which is just a regular purchase loan, as if it was an existing home. And they're going to move in at the very end. So in this scenario, they're going to try to sell their house and kind of delay that until the very end, maybe work out a lease purchase until their home's finished or something like that. But this might come into play where, if they don't sell their home at the very end, or they want to maybe, if they're finishing up in this market in the winter, and maybe they don't want to sell their home and they want to sell it in May or, June into like the April or spring market, and they might maybe get more for it then they might close on the new property, use these programs to guarantee that. So we don't have to use both mortgages, and their home will be guaranteed if it doesn't sell within a certain time period.
So just to refocus on the question, her clients haven't made any offers yet. So do you have any input on that? Whether it's more attractive to use one of the programs or whether they should just make offers, contingent?
Yeah. So depending on what the seller, in this situation, the builder, is looking to do, if he just wants to, close on that and then start building, then this would be a good option for them. They could do the same thing. So if they're gonna get a construction loan, they could close on the 12-month option where there's no payments for 12 months, and then sell their home at the end, pay off that cash out refinance, and then move forward after that.
Oh, okay, so
might be a good
really,
option.
from what all the programs you offer today in this particular scenario with these customers and buyers I'm talking about, none of the ones that you just recently introduced would come into play. It would be more the construction loan. Did I follow you?
If they're going to get a construction loan and they don't qualify for the construction loan and their current home, then this would be an option for them.
Got it. Okay.
Exactly.
All right. Thank you.
Yep.
And you're going to send us those handouts, the
Sure. We can send you out like the Zavvy handouts, and you got some different flyers and things. Even if you want to incorporate them in your listing presentations, you could do that as well.
Okay. Thank you.
Sure. Yeah.
Yeah, that's as we all know, that's exactly what's going on right now. I have everybody, people my age and what have you, in 50s, whatever they are. They got a ton of equity in their home. I don't want to sell I don't have to sell my house. I understand that. Yeah, but so I will when I have to buy it. So, well, can you pay cash for it? Can you? Well, yeah, no. Well, so it's just like, and then it's contingent. And even though we know we can sell the home, we're all on the listing side. You have 5 offers, and I've got 3 that don't have to sell their homes.
Right.
Obviously we're always going the path of least resistance unless somebody's really blowing an offer out of the water.
Yeah, exactly. I mean, we see, sellers going with a lower amount, with a higher down payment. For that's just one reason. But to have a home contingency sale in there, none of those, for the most part, are getting accepted. So these are just some good options to be able to waive that home financing contingency option in there.
Yeah. And with the different options.
The home sale contingency, yeah.
I think the thing, you're right. Refer them to you at the listing or before, because there's different options. So
yeah, and some people just don't want to pay 2 payments either. So they might be comfortable doing that, but they don't want to have 2 mortgage payments. So they want to have the least amount of 2 mortgage payments as possible. And they're not quite sure how long it's going to take for them to sell their home. So, right up front, the first and best option, even if they never use it, is just to get a home equity loan line of credit on their home for the maximum amount. And that gives them a ton of different options. Because There's some other options in here too that we didn't talk about. Like there's other types of mortgages on the buy side that aren't just your regular conventional VA, FHA, USDA, things like that, New Hampshire housing. They're like bank statement programs and debt service coverage ratio programs for investment properties. There's 1099 programs. So someone might not, if they're, let's say, self-employed, they might not qualify for both mortgages. But if they have that home equity line of credit for $300,000, let's say, or $200,000, whatever it is, and they can use that money for the down payment on the new property, let's say they can put 25% down, then we could do like a bank statement program for them. And a bank statement program is if you're self-employed, you might try to write off everything. So your net taxable income isn't enough to maybe qualify for that loan. But if we take their last 12 months of bank statements, add up all their deposits, divide it by 2, then we can use that as income for them. So they can just get that home equity loan for basically no cost, do a bank statement program, get into the new property with a different type of program and not have to worry about all these cash assistant, cash offers as a backups and paying 2%, when their home sales, to have someone just write up an offer to waive that, the mortgage payment on their home that they're selling. So the biggest benefit to tell a seller is to get that home equity line of credit. If they never use it, great. If they do use it, then it gives them a lot of different options.
Mhm. Sounds good.
Yeah.
Great.
So yeah. Any other questions? You guys can always email me, give me a call anytime. Have your sellers call me at any time, and your buyers, certainly call me anytime, and we'll go from there.
Thank you very much. Appreciate the
Great.
information.
All right. You guys got it. Well, have a
Awesome.
great day.
You do the same. Thank you so much.
Thanks.
Appreciate it.
Yeah. Bye-bye.